So in this section, we'll be completing the financial statements of the company DPN Ltd. They sell household products and their financial year end is the 28th of Feb 2024, right? And we're going to be doing question 1.1 in this video and 1.2 and 1.3 in the following videos. So they say the bookkeeper has recorded all the entries regarding to the fixed assets in the books. Complete the amounts denoted as Roman figure 1 to Roman figure 3 in the fixed asset note, right? So here's the fixed asset note that they gave you here. One thing I want you to understand is I want you to understand the structure of the fixed asset note, that you have your different classes of assets. So you have buildings over there, you have vehicles, and then you have equipment, right? And how the fixed asset note is structured is the first part, they basically give you the carrying amount or the carrying value of the class of asset at the beginning of the year. So how you get this carrying amount is you must say cost less the accumulated depreciation at the beginning of the year, and then you get the carrying amount at the beginning. Same thing with at the end here. To get this carrying amount, they took the cost less this accumulated depreciation. So now you know that's how you calculate carrying amount. Carrying amount is always, so I'm just going to write here, carrying amount or carrying value is always the cost less accumulated depreciation on that specific date, which is what we see over here. And then in between we have your movements. So your movements are your changes in these classes of assets, right? So what can cause a movement is if we buy new assets, which are additions, or if we dispose assets, meaning that we sell them, and the depreciation, right? So depreciation is basically the decrease in the value of the assets as we use them over time. So as we use the assets over time, their value depreciate because they become less useful, and then we need to decrease the value of these assets. So this is what causes the movements, the additions, the disposal, and the depreciation. So I want you to be familiar with the structure of the fixed asset note. I just wanted to take a moment to share the secret hack with you. Stop wasting money on generic tutoring. Most students don't know about this, but it's a platform built to help you pass with structure, strategy, and a system that actually works. It's called Genius App. They guarantee a pass in your exam, or they give you your money back. So if you go to their website, geniusapp.co.za, and you go to programs and you scroll down, you'll see that they use the mastery-based approach in their learning, and they also have a 100% pass rate, meaning that all the students who fully participated in their programs have passed. And if you scroll down, you'll see that there are one-on-one lessons whereby if you want a more personal, intimate tutor, then you can go and book a tutor there. But they are online exam prep programs. That's where they guarantee a pass or they give you a full refund. And if you go to sign up today, you'll see the courses or the programs that they currently offer, and you can filter up here according to your year of study and say grade 12, and you can see that they have the grade 12 accounting June exam prep that you can enroll for now. But if there's a program that's not here, maybe there's a specific subject or course that you'd like to see, you can just drop it in the chat and tell them what course or program you'd like to see. So hope you use this resource and you also pass your exam stress-free. Cheers. But they told you that the bookkeeper has already completed some of the transaction. All you need to complete is this Roman figure 1, Roman figure 2, and Roman figure 3. So let's get to it. Roman figure 1, they say you must determine the cost of the buildings at the beginning of the year. Remember I said the first part we're only dealing with amounts at the beginning of the year, right? So how can we calculate this? Because if you read your information, there's nowhere else where they told you about buildings. But one thing that you know is they gave you the carrying amount at the end. They gave you the carrying amount at the end. And with buildings, most of the times in grade 12, you don't depreciate them. So there are no depreciation. There are no depreciation for buildings most of the times in grade 12, right? So basically, you know that the only thing that can cause a difference from the cost in the beginning to the cost at the end, or the carrying amount at the end, it's your addition and your disposal, right? Because most of the times you don't have depreciation on buildings, right? So those are the only two things that can cause a difference. And they gave you the amount, but with additions it was 0, meaning that we didn't buy any additional buildings during the year, but we sold a building at carrying amount, which is 420,000, right? So this is what caused a decrease in your buildings. So to calculate the cost at the beginning is simple. You just have to take the cost of the end and then you work backwards. So what was subtracted, you add it. So if you take this amount at the end, you take this amount at the end and then you add this 420, you will be back at the cost that was at the beginning. Remember, I said with buildings there's usually no depreciation, so the cost here will be the same as the carrying value, same as at the end here. The carrying value at the end will be the same thing as the cost. But this was a simple one because all you needed to do is to say, okay, cool, they gave me the carrying value at the end, and I can work backwards and add this one and then get that amount. So I'm just going to write it down. So we have your 900. Now let me write in black. You have your 904,21300, 300, which was the carrying value at the end, and then you add the building that was sold or disposed during the year, because at the beginning of the year it was still in our ownership. Therefore we would see it as the carrying amount or carrying value at the beginning. So you basically take carrying value at the end, you add what was disposed or sold during the year, and then you get the carrying amount at the beginning, because the carrying amount at the beginning included the building that was sold during the year. And then we can move to Roman figure 2. So Roman figure 2, we have to calculate the depreciation of vehicles, right? So we have to calculate the depreciation of vehicles for the year 2024, right? And let me give you a trick. Whenever you're calculating depreciation, calculation, I want you to write this down before you even start calculating, because it's going to guide you. I want you to write SUN. So what is SUN? Basically with SUN is you're going to calculate depreciation on the assets that were sold, calculate depreciation on the old assets, meaning that the assets that existed at the beginning of the year, meaning that we bought them in previous financial year, and then you're going to calculate depreciation on the new assets which were bought during this current financial year, right? So that's how you always do it, right? You calculate depreciation for sold, old, and new. So I always write SUN so that it gives me some sort of guidance, so that I know what I'll be calculating, right? And most of the times you'll realize that obviously first you need to understand what's the basis of calculating depreciation for vehicles, right? And they tell you that it's 15% per annum on cost. So we calculate depreciation on cost, meaning we always take the cost of that vehicle, multiply by 15%, and that's the depreciation for the entire year, right? So in this case, we're going to start with new. So new is always my favorite one because it's easier to calculate. You're going to have the cost of the new asset or the new vehicle. So if you look at your asset register, remember I said your additions are the assets that were bought during the current financial year. So they bought vehicles who had the value of 260,000, right? And so we basically gonna have to say 260,000 times 15%. That will give us the depreciation on the new vehicle for the financial year 2024. But we need to take into account, because if we just multiply by 15%, that's depreciation per annum, meaning that for 12 months. But did this new asset stay in our business for the whole month, right? The whole year, I mean, right? So we go and look, when did they buy this vehicle? New vehicle was bought on the 1st of October 2023. So you see, they bought it on the 1st of October 2023, and we're calculating depreciation for the 20, what's the date? 29 of Feb 2024, right? So they bought it 1st October 2023. Let me just go draw my timeline so that you guys can see what we talking about. So I have my timeline here, and I'm saying we're calculating depreciation for 29 Feb 2024, meaning that the financial year started on the 1st of March 2023. But this new vehicle was bought on the 1st of October 2023. So I'm going to put it somewhere here. 1st October 2023. Right? Meaning that we're going to have October, November, December, Jan, and then you have Feb, right? So you have Feb. So this is the 1st of October, this is the 1st of November, 1st of December, 1st of Jan, 1st of Feb, and then the financial year ends, right? So how long did this new vehicle stay in our business? 1, 2, 3, 4, 5 months. So it stayed in our business for only 5 months. So meaning that the depreciation that we calculated here, will need to apportion it for 5 over 12 months. And then when you add those, you'll get you have to get 16 to 50, 16 to 50. And then we've calculated the depreciation on the new. Now you can go and choose. I'll go back to the sold vehicle. Did we sell any vehicles during the year? And if you go to your fixed asset node, you realize that under disposal on vehicle, they have 0, meaning that they didn't sell any vehicles during the year. So here, meaning that we don't have this. We basically have 0. For old, now we're going to say, what's the cost of the vehicles that were bought in previous financial year? And then after that, we calculate depreciation for the year. And if you go here, you'll see that you have the cost of the vehicle that were bought in the current financial year, which is 260, but you don't have the cost of the vehicle that were there at the beginning of the year, right? They shaded this area, meaning that we don't have the cost, but you have the cost at the end. They give you the cost at the end, which is 786,000. 786,000, right? So if you take that, we're here on the old. If you take the 786,000, which is the cost at the end, and then you minus cost of additions. You minus the cost of additions, meaning that the asset that were bought in the current financial year, which is 260,000, the amount that you get here, which is 526,000, this is the cost at the beginning, right? So you took the cost at the end, you subtracted the additions, and then you get the cost at the beginning, because the cost at the beginning did not include these additions. So that's why we subtract them. So what you're basically doing, you're doing the same thing we did with buildings. You're starting with the amount at the end, and then you're working backwards. Because the additions were added, you subtract them to get the cost at the beginning. Now we have the cost at the beginning, which is 526,000. You multiply it by 15%. Did this asset stay in our business for the entire year? Yes, because they were there at the beginning of the year, and we held them until the end of the year because we didn't sell any. Therefore, we're going to multiply it by 12 over 12. And then that will give you, it should give you 7,800,900. And then you put the total there, 7,800,900 plus 16,250. It should give you 9,5,150. So you see the process. You always calculate depreciation on the new first because it's easier, and then you calculate depreciation on the sold first, and then after that you can go to the depreciation on the old. So the old is old assets that stayed for entire year. So if we had any vehicles that were sold during the year, we're going to subtract their cost here as well. Because if we don't subtract them, we're going to get the wrong depreciation amount here. Because here we're speaking about assets that are old, were bought in previous financial years, but they stayed for the full 12 months in this current financial year. But with the sold, we might have sold them during the year, therefore we need to apportion them as well. But in this example, we didn't have that, so that's fine. We just calculated our depreciation, and then you can go put it here. So I calculated it that side, but you can do the same calculation here in your exam, right? So we can go to the carrying amount, the carrying value of, so I'm just going to erase so that it's cleaner. So we can go to Roman figure 3, which is the disposal at carrying value. So here's another thing I want you guys to really pay attention, that additions are always at cost, disposals are at carrying value, meaning that you'll need to calculate the carrying value of that asset on the date that it's disposed or sold, right? And after you get that carrying value, that's the carrying value you use to decrease your fixed asset note. So let's go. What's the disposal carrying value? Right? We're gonna read more on it. They say here's the information or the fixed asset register for the equipment that was sold. It was bought for 80,000 on the 1st of September 2021. The date it was sold, it was the 31st of May 2023. So let me go to my timeline. They say 31st of May 2023. So I'm gonna put it somewhere here. I'm gonna say this is the, now this is far. Let me put it somewhere here and say this is the 31st of May 2023. Right? So I'm gonna say May, which is the 1st of June. So it's the 1st of March, 1st of, yeah, my timeline, 1st of March, 1st of April. And then I'm gonna put May here. Yeah, I'm gonna put May here. And I'm gonna say this is the 31st. Let me bring it closer. I'm gonna say it's the 31st, but it's the same as June. And then we have July. Yeah, my timeline is not timelining now. Let me write it properly. So we have March, April, May, June, July, August, September. And then we have October, November, December, Jan, Feb, and then the year ends. So that's 12 months. And then they saying this fixed or this equipment was disposed of on the 31st of May 2023. So I'm going to go and say 31st of May 2023. So 31st of May, it's here. Because remember, this is at the beginning of May, and this is the end of May. So they sold it here. This is where the equipment was sold. So it only stayed in the business for 1, 2, 3 months in the current financial year. They gave you here the carrying amount at the beginning. So the carrying amount of the beginning of the year was 57,600, and it only stayed in the business for 3 months, meaning that we'll need to calculate depreciation for 3 months and then decrease this carrying amount by that depreciation for 3 months, because the value of the vehicle decreased for 3 months, right? And then after that, we get the carrying amount on the 31st of May 2023. And they told you that equipment, the depreciation is calculated on 20% of diminishing balance method. So diminishing balance method, basically what they say when you see diminishing balance method. So when you see diminishing balance method, it means that whenever you calculate depreciation, your step number 1 is to get the carrying value of the asset at beginning of the year. So you get the carrying value of the asset at beginning of the year. Step 2, you take that carrying value at beginning, you multiply it by the percentage, right? In this case, it will be 20%. So 20%, right, which is your depreciation percentage. And then after that, step 3, it's a portion if necessary. So you're going to take whatever amount you got here, multiply it by the number of months that the asset stayed in our business. But the key thing is you always calculate depreciation on the carrying amount at the beginning. Difference with the depreciation on cost is because whenever we calculated depreciation, we only used the cost amount. We use the cost amount, how much it costed us to buy that asset. But here we always need to calculate or find the carrying value of that asset at the beginning. So let's do that with our thing here. Do we have the carrying amount of the asset or the equipment at the beginning of the year? And the beginning of the year is the 1st of March 2023, right? So we can go. So on the 28th of Feb 2023, which is the same as the 1st of March because it's the next day in the morning. So it was 57,600. So this is the carrying value at beginning. So we have the carrying value at the beginning, which is 57,600. So we're gonna say 57,600. And I said after we find the carrying value at the beginning, in this case we were lucky they gave us that carrying value, we multiply it by the depreciation percentage. In this case they said it's 20% on the diminishing balance method, and then after there we multiply by the number of months this asset was in our business. And by doing that we get how much? We get 2880. So remember, this is depreciation for current year. This is depreciation for the use of the current year. But we're not looking for depreciation. We're looking for the carrying amount of that asset on the date that it was sold. So to get the carrying amount at disposal date, we're gonna say what was the carrying amount at beginning minus depreciation for current year. So the value of this asset at the beginning of the year was 57,600, which is what we saw over there, and we have to minus by the depreciation for the 3 months in the current financial year in which we used the asset, which was your March, April, and the whole of May. And then after that we get the carrying amount at disposal, which is 54720, and then we put it there, 54720. So that's how you calculate your carrying value of the equipment at the beginning. So it's always step number one, find the carrying value of the asset at the beginning of the year, and then after that use it to calculate the depreciation and apportion for the number of months that asset was in the business. So I hope you found this video valuable. See you on the next video. Cheers.